Good morning, everybody. Okay,
Morning.
there we go. I got a wave from Jasmine. I was waiting for somebody else to speak up. Fantastic. Happy Wednesday, and thanks so much for taking a little bit of time out of your day to join us this morning. We will get to wins and lessons learned from yesterday, as well as any questions you might have that need to be addressed. But first, because we have a guest joining us this morning and we want to respect everyone's time, I want to take a moment to introduce Juan Escobar from AmeriFirst Home Mortgage. We asked Juan to come and join us again today. He joined us a short time ago, probably a few weeks now, and talked about some other things, but some of the things that came up in our conversations as a team included USDA loans and how things like, oh my God, I'm totally losing my verbiage right now. Child support and alimony. Yeah, child support, alimony played into talking about someone's debt load or income level when they're applying for a mortgage loan, and also what qualifies as qualified income. So we asked Juan to come back, shed a little bit more light on that. And if you have any questions, I'm sure he'll be happy to answer them at the end. But for now, I will stop talking and allow Juan to start and take it away whenever you're ready.
Perfect. Well, thank you guys for having me again. It's a pleasure. I've had the great opportunity to work with some of you guys already, and I really appreciate that. I know that doing these things will help build that relationship. So if you guys ever have any questions, you guys can always text me, call me, email me. I'm pretty much always available. So yeah, you guys wanted to learn a little bit more about renovation loans, USDA, qualifying income, child support, alimony. We'll briefly go over those. If you guys have any questions, please, we'll leave it towards the end. That way we can get through those in this presentation quickly, so you guys can have your time for your meeting. So what we're going to be talking to you guys about: renovation loans. What are they? What are some of the guidelines? What are some of the strategies that we typically talk to our partners about being able to add these into their conversations and their sales strategies? So what are renovation loans? Essentially, renovation loans are loans that allow you to add the renovation costs into the mortgage, so that you don't have to leave the purchase of the home and all of a sudden have to do a ton of different transactions, whether it's fixing a kitchen or adding a room or adding a pool. You can add this all into the loan. So the way that it works is that we get a bid up front. That's the work that the borrower needs to do. The seller has nothing to do with a renovation loan. When you buy a house, essentially it's the exact same thing when you're putting in a contract. But the borrower has to get a bid in the work that they want to do on the house up front. And what they do is they'll give this bid to the appraiser, and the appraiser will go out to the property and do an after renovation value, meaning that they're taking into account all the work that you put on this bid to get an appraised value. And that's what the bank will go off of. It can be used on any property, regardless of the condition. Allows for structural changes and repairs. There is some programs that may be excluded from that. The work is always completed after closing. So again, we're not bothering the seller at all. It allows the buyer to shop location. Maybe they're looking at a specific area, but they're seeing that everything is too expensive, or they're just not finding much that fits what they want to get in the home. But this allows you to actually buy a property that you could find a gem, let's call it in Windermere, but it's run down and needs a lot of work. You could get it for a very good price, add the renovation, and potentially even have equity after you do all the work. It just gives the realtors a little bit of flexibility in where they're going to be able to look, and because essentially you can build as nice of a house that you really want, since you're doing the renovation and you know what you want. You fit it to the buyer's needs and wants. So there's definitely VA renovation. It comes with all the benefits of VA, with 0% down. You can do aesthetic improvements. The home must be habitable. The project must be completed in 60 days, and this is specifically for VA. For this program, you can't do structural changes or repairs, no outbuildings, and then the veteran cannot be their own contractors. Again, this is specifically for VA. Then we have the FHA 203K standard. It's essentially an FHA loan. It's 3.5% down minimum. You can get the 6% seller's contributions or interested party contributions. You are allowed gifts as long as they qualify as gifts, like regular FHA loans, which obviously, you know, the funds must be sourced. It must be from an eligible source, etc. You're allowed to use a HUD consultant. It's essentially what a HUD consultant is a project manager. And they can assist you throughout the process. And we here at AmeriFirst also have a full renovation team that we have a processor to deal with conditions for regular loans. And then we have a renovation processor that will help us with all the renovation conditions. There is a couple more things that need to be done when it comes to renovation. We do vet the vendors to make sure that they are able to do the job and the work is going to be done timely, etc. With FHA, this is something that you guys, if you're going to walk out of anything today, you can increase the appraisal value on an FHA up 10% if needed. So that could potentially save the deal. If for some reason it doesn't appraise, and then you switch it over to an FHA 203K, you could increase up to 110% of the purchase price, and that's what the bank will lend on. So that's huge. Definitely keep that in the back of your head. You can finance up to 6 months of your principal, interest, taxes, and insurance payment if required, if the home isn't habitable for that period of time. It doesn't have to be 6 months. You don't even have to do it. And no startup money to the contractor, unless it's a special order item. We do a draw period where we'll, you know, pay as the job is being completed to protect the borrower. What kind of work can you do in an FHA 203K? What kind of allowable repairs? You can do kitchens and baths, roofs and sidings, flooring and paint, wells and septic. You can add rooms, garages, and pole barns if common for the area and reflected on the appraisal, in-ground pool repairs, structural repairs, anything as long as it's not luxury. For 203K, you really you can't do a pool. And just remember too, it has to appraise. This is very important. It has to appraise. So yeah, I can put let's call it a regular conventional loan that we do renovation on. I can put a pool, I can put all these luxury things, but if it doesn't add value to the house, it won't appraise. Meaning if it doesn't appraise, the bank will only lend on that after renovation value, and you guys or the buyer will have to come up with the difference. So that's something that's very important for the borrower to understand. And when you guys tell them, just say, look, you know, when you're doing these repairs, let's make sure that it's stuff that's adding value to the house. You know, master bathroom, kitchen, adding rooms, paint always provides a little bit of value, but it has to appraise, and you just want to make sure that any work that's being done does provide value back into the property. The FHA 203K limited, it's essentially the same thing. FHA loans, same conditions as far as 3.5% down, gifts, all that good stuff. But this does not allow for a HUD consultant. The project is limited to 1,000. It's almost actually 30,000, because with these loans, there's always a 10% contingency, meaning that if you're doing $100,000 of repairs, the borrower will have to either finance or bring an extra 10% of that 100,000 in case the repairs don't cover all the costs. So with this program, you really are more about 30,000, because you have 10%, which is 3,500, and then inspections fees. So it must be less than 35,000 all in. With this one, again, the work is limited, no structural changes or repairs. You can increase the value by 10%. You cannot finance principal, interest, taxes, or insurance, because it must be habitable after closing. And then up to 50% of the bid amount can be advanced to the contractor if the contractor requires it. So this one's a little bit more limited to the repairs. You can do plumbing and electrical, kitchen and baths, roof and siding, doors and windows, AC, flooring and paint, wells and septic, in-ground pool repair. So it's a little bit different with this one where you can do pretty much anything except for luxury. And this one, which is, my favorite, obviously, we all love conventional. So very similar terms as far as regular 5% down. You can do up to 95% LTV, the same 3% seller max contributions. You can get gifts. It utilizes a plan reviewer more than a HUD consultant instead, but essentially it's the same project, same job. It does allow for structural changes. Keep in mind that the 10% increase in price, this only applies to FHA renovation loans. It does not apply to the conventional loans. You can finance 6 months into the principal, interest, taxes, and you can finance up to 6 months of principal, interest, taxes, and insurance, as long as the house is not habitable. There can be upfront money to the contractor on a case-by-case basis, and we have our team that will review that. And this does allow for second homes and single-family residence for investment properties. The FHAs is essentially all primary homes. The allowables and repairs, this is pretty much anything, same things as the FHA 203K regular, but you can add pools, you can do repairs, you can, as long as it appraises, you can do whatever you want. And if you're willing to pay the difference, if it doesn't appraise, then, essentially you can put, at least, save some cash and be able to finance this into the mortgage, which $30,000 over 30 years, it's a lot cheaper than having to fork out $30,000 right now. So the most important thing with this program is understanding the timelines. We can close this in 30 days, but it's going to depend up to the borrower to do their homework up front, which is getting these bids up front. If we don't get the bids up front within, the first week or so, this could extend the closing, by a week or two. Typically, we say 30 days if we get those bids within the first week. Sometimes I would say we need 45 days, depending on the contractors getting back to us on time, the appraisal, and the location. Sometimes these are a little bit more complicated. Typically, you still have to get permits. So this should be included in the bid when possible. It doesn't happen all the time. Meet multiple contractors. You don't want to go with the first bid. Sometimes, you doing some research could save them a little bit of money. So definitely recommend that to your borrowers. Renovation loan lending, is closer to new construction lending than it is to regular loans, but it's still very similar, the same process. We have an amazing team. We're probably one of the biggest renovation teams here in Florida. When 2008, 2009 happened, that's how we built some of our names here. We have Nick Long, which maybe you guys have worked with in the past. He is the master of renovation loans. So I always have that resource to go and ask questions to him, and he does tons of these. He's the manager for that program here. So we have a great resource and plenty of knowledge here at AmeriFirst. So some of the things that this could help you guys when I guess helping your borrowers is you can update amenities. That's very important. You can get new stoves, new different things that could have potentially help you add value. If doesn't appraise, we can use those FHA loans to increase that appraisal value so we can still get that loan closed. What we like to say here at AmeriFirst with these loans is build your own inventory. This allows you to build your own inventory when it isn't there. So if you see that all these houses are flying off the shelves, but there's a house that's been sitting on the market for 30, 40, 50, 60 days, 90 days, this could be something you can definitely take advantage of and sell the borrowers that, hey, look, we can get you the house of your dreams. And you can pay, $100,000 less, but let's do $100,000 of renovation, and then you get the house that you want in the location that you want, and it's a win-win. You could potentially even gain equity out of the house when right now people are essentially in negative equity because they're paying so much above asking. So this is a really good opportunity for those price sensitive people as well. You can do bank owned renovations on those, more listing opportunities. You can even go to, call it, downtown Orlando and find those historical homes that need a lot of work and do these types of loans. You could do it on second homes or investments for conventional, and then you have the ability to sell location more than selling the property. Again, you can find those gems in a Windermere, in a Winter Park, you know, somewhere where houses just need some work and that are older homes. So it's a really good opportunity, and I think it's something you guys should definitely consider in your conversations whenever you have those tough borrowers or borrowers that you just can't seem to help or find anything that they really want. Maybe new construction isn't what they want, but they want new stuff. So this is a really good program for that. I'll speak in regards to now USDA loans. So USDA loans are essentially loans for rural areas. That means if you look at the map, everything you see in dark yellow is not rural areas. So in Florida, where you guys are in Central Florida, it's really not a program that's used a lot because there's not a lot of availability when it comes to Central Florida. But once you get on the outskirts of Central Florida, then you're starting to see that there's a lot more locations for it. Ideally, you want 640 credit score for these, and the higher the better. They're tough loans. Not everybody qualifies. They are 0% down, so they're a little bit more stringent in regards to the properties. There is income limits. So the income limits is very important to understand that it's not just, okay, I'm the borrower and you're only counting my income. No, we do household income. So whoever's in the house, everybody's income needs to be counted to make sure you meet those income limits. Very important. It can only be for primary residence and non-rental producing homes. So pretty much single family homes, etc. If you guys get I'll send this presentation to you guys again, and I put a little link so that you guys are able to see the map and you can search per zip code so you can see if a specific property qualifies for that. And there is no max loan amount, but just keep in mind that you do have income limits. So it kind of sets its own income limit. Something that's really cool about this program is, one, it's 0% down. You don't have to bring any down payment, but it's very important to also understand and let your clients know it's not like there's just no fees and there's no closing costs. There is closing costs, and typically closing costs can be 2 to 3% depending on the price of the home. So there is money that they do need to bring. So it's not like just it's free, right? It's not. It'll be tough to get that, but what this program does allow is you can roll up to 2% of the purchase price as far as closing costs if the house overappraises. So that's key, but we won't know that, and we really can't qualify somebody on the hopes that the house overappraises. So they need to have those funds. Now, if they have the funds and the house overappraises and they don't want to use the funds and roll that max 2% of the purchase price into the loan, we can absolutely do that. Some of the eligible properties are essentially pretty much the common ones: detached, attached, condominiums, PUDs, modular or manufactured homes are all eligible, as long as they're single family residences and they are non-income producing. We only have 30-year fixed loans on this program. You can get seller contributions or interested party contributions up to 6%, and we do allow gift funds. So their gift funds are still need to be verified and come from an eligible source. Okay, so qualifying income. This is when it gets a little bit complicated, because just because you work and you make certain kind of income doesn't necessarily mean that we can use it for lending purposes. All income is not the same. Somebody's income as a full-time employee is different than a part-time employee, and it's different than a self-employed borrower, and it's different than somebody who is a salaried employee. Essentially, we'll start from the easiest way to calculate. If you're salaried, even if you just started, essentially, if you have that 2-year history, you're good to go. We use that salary amount, and we can qualify you based on that. We'll do a verification of employment, and you can qualify on that salary. Now, if you make bonuses or commission, you typically need to have at least a 2-year history of receiving it. In certain situations, when it's expected to continue and we can verify, or you've done it in a prior job, we can use 12 months, but that's going to be on a case-by-case basis. The lender needs to just verify that the income is both stable, reliable, and will continue for at least 3 years. And we have different methods of determining that, depending on the nature of the income and how they're paid to the borrower, if we can use it or not. So different types of income are self-employed income, typically requires 2 years of tax returns. And remember, with self-employed income, it's not about how much you make. I can make $1 million on my company, but if I'm claiming 25,000 after deductions, then we're going off of 25,000. We are not going off of over the $1 million. And that's something that's very important to stress to your borrowers, just to let them understand, like, and not get upset with us when we tell them, hey, look, we really can't qualify. You're only claiming about $25,000 of income and you're trying to buy $1 million property. You do have to show that you're making that income, because essentially you're saying that after fees, you're only bringing home $25,000. And we can add back W-2, they pay themselves W-2. We can add back depreciation. We can add back mileage depending on the way that they file taxes. So there is income that we can add back to the net income that they claim. But again, we're going off of net income plus those deductions, not off of gross, okay? Overtime income, 2 years, typically what we need. And remember that we have to go based on a 2-year plus year-to-date average, typically. But we go in a worst-case scenario. So let's give you a quick example. And I know I'm running out of time probably, but quick example is, in 2019, they did 10,000. In 2020, they did 20,000. And in 2021, they did 9,000 of overtime income. In that case, we would not use a 2-year average plus year to date. We'd actually go worst case scenario, we would be year to date to qualify that overtime, because that means that they did good increasing overtime over 2019, 2020, but in 2021, it was much less. So we can't go off of higher amounts if in this year you're doing less, because what is the chances that it's going to expect it to continue for 3 years at those higher amounts if you had a decrease the prior year? But let's bring it back to a kind of like an opposite. And this is the same for bonus income as well. So let's say you did 5,000 in 2019, 20,000 in 2020, 50,000 in 2021. Then at that point, we'll also use a 2-year average plus year to date. So it's always going to be worst case scenario, so that the bank can protect itself from maybe overestimating what that income could be, because then the following year could go back to those original numbers. But if it's consistent, it should be very stable, which is what we like to see. Rental income, we're going to go based on if they filed taxes for that rental income, if they've owned the property for over a year, and we'll go off of what the net is, plus adding back some deductions like taxes, insurance, mortgage interest. You have a couple other things that you can add, depreciation, HOA. So we'll go off of that if they've owned it for over a year. If they do not claim rental income on the properties that they own, that they're renting out, we cannot use that income. And we have to count the entire liability, taxes, insurance, mortgage payment, HOA. So it's very important, because a lot of borrowers just don't want to pay taxes, and they will just not claim it, and they're going to try to buy a house and use that rental income. We cannot use it. We cannot use a lease. Only time we can use a lease is if they didn't have enough time to show a full year on tax returns, or if they've owned the property for less than a year. Then we can use a lease, and we can use 75% of that lease to offset the mortgage liability. So variable income is like part-time. It's going to be the exact same thing as overtime and bonus income. You need at least 2 years, and we're going to go the average over the past 2 years plus year to date. Social Security, as long as they do not pay taxes on that income, we can use it. And you can use it either way, but we can use it and gross it up 15% for FHA or 25% for conventional. So if you make $1,000 a month, we can use $1,250 for conventional or $1,150 for FHA. And child support and alimony income can be used as long as it's expected to continue. FHA or conventional has different requirements on to what it needs to be able to qualify. So alimony and child support, I know you guys were interested in this, are both acceptable sources of income. We must verify that they will continue to be paid for at least 3 years. Typically for conventional, it must be court ordered. For FHA, it can be optional if the ex-husband or the dad wants to pay it, but we do need to show that it's been received, and needs to be consistent, and it needs to be at least 6 months. The lender is going to verify that we'll continue to be paid for at least 3 years. We must show receipt in full and timely for 6 months for conventional in order to use it. If you see that it's unstable or received less than 6 months or partial payments are made, unfortunately, we will not be able to use it. As far as liabilities goes, they're going to be added just like a regular liability. Child support, you can add it just as a monthly debt. Let's call it a car payment. It's the same thing with child support. Now for alimony, and this is something that's not a lot of lenders know and could literally be the difference between you getting accepted or not, is that alimony, we have the option to either decrease the income. So if your income is 5,000, your alimony is 1,000, we can decrease your income to 4,000, or we can add it as a liability. So what a lot of lenders don't know is that if you actually decrease the income, instead of adding as a liability, your debt to income is lower. So that could be the difference maker between you getting a 49% DTI and not getting approved, or a 45% debt to income. So that's key, and something that, obviously we take advantage of when we can to get people lower mortgage insurance or better, pretty much mortgage insurance, just what's affected the most by DTI, or just get them approved in general, honestly. And that could be something that could save a deal. So that's all I had. I know it's a lot of information. I'll definitely send this out again to Lee. I added a couple of things. Let me know if you guys have any questions, and then if you guys want me to clarify anything, let me know.
Did the renovation loan, was that on top of a mortgage loan, or is it all rolled into one loan?
It's all rolled into one loan. So let's say you have a $200,000 purchase price. You have a $100,000 renovation. Let's say we're doing conventional, 5%, that's 15 grand. Your loan would be 285.
Okay.
One
and
loan,
does it change the rate, interest rate? Is it?
Yes, it's slightly higher. It's about a quarter okay. higher. But remember, you're doing a $100,000 renovation at a 2.5, or sorry, call it 3.5% with how rates are right now, instead of going to get a personal loan from a bank at 10% down. I'm sorry, 10% rate.
Right. Thank you very much.
Mm-hmm. Anybody have any other questions?
Thank you so much, Juan, for taking a portion of your day to come in and share the information you have. I know that was what you covered are things that, well, actually more than a few people on the team were wondering about. So I hope that this provides some clarity. And thank you also for making yourself available in case there are questions that come up in the future. That's super helpful to know that we have someone we can turn to with questions like that.
Yeah, you got it. Anytime you guys need my help, I'm here. You guys come to the office all the time. We love having you here, and hopefully we can get some closings on the books so we can help your clients. I think they'll be really happy with everything we do here at AmeriFirst.
Fantastic. Thank you so much.
You got it. Well, thank you guys. Enjoy your day and have a great meeting.
Thank
Thank
you, you
you.
too.
Thank you.
All right. So, Ben, are you ready to start talking now? Apparently not. All right. So let's talk about yesterday. Tell me about your big wins from yesterday. Or your lessons learned. Nobody had anything happen yesterday?
I've had something ongoing with my closing on Friday. I finally got clear to close. So Friday morning, we will be closing on Lady Diana and we will be good to go.
Yes. And is that your first closing?
Yes, on a house. Yeah.
Fantastic. How do you feel?
I learned a lot, so I'm happy about it. And
Excellent.
I learned a lot about solar panel loans. So if anyone has questions, come to Lee or I because we
Yeah.
know about them.
Kelly's rolling her eyes, maybe physically and maybe internally.
Congratulations, Matt. That's awesome.
Thank you.
Yes, that is so awesome. And I'll tell you this, Matt, just so you know, it was something we talked about a little bit yesterday. Once you have that first closing, it's like a drug. You absolutely have to have another one. It's an exciting process. And then when you finally get to the closing table, it's like, oh my God, I need this to happen again. So congratulations on the first one. I hope it's the first of many, many for you.
Thank you. Thank you.
What else? That was a fantastic big win. What else happened yesterday? Nothing else? What lessons did you learn yesterday?
When I went on the contract on that couple that I told you guys about, that Manuel referred to me that they were working with another agent. So I think I'm specializing on taking clients away from other agents. This is like my fourth. So yeah, that's exciting. Definitely. It's a new construction. Richmond. Rashid has been awesome because he's dealing with them as well. So he's been helping me out. And so yeah, that's exciting.
Cool. Anything else from yesterday? All right.
No, but if nobody speaks up, I'm going to ask Matt to share his lessons learned on solar.
That's actually not a bad idea. Matt, did you have any lessons that you learned specifically about the solar loan that you'd like to share? Because that is something that keeps coming up. And honestly, as more and more people wind up with solar panels installed on their homes, I'm sure it's something we're going to keep running into.
And were you representing the buy side or the sell side?
The buyers.
Okay.
I will say it was just like overall, it was a big lesson learned, but I think some of the things that stuck out for me was that the listing agent kept pushing to make sure that they were trying to go and set up their account and assume that solar panel loan with at least 30 days out before close, because it takes a while to do the transfer. So it ended up taking that long, and like my buyers were kind of like dragging their feet when it came to that, but I just tried to keep staying on top of them because they just went and got everything assumed, like their account was all done, everything was put in their name yesterday, so it was really close when it came down to closing. So that's probably the biggest thing, was like as soon as you can get them in contact with the company and then get them to set up their account, because they have to pay like a fee and they have to do all of these little things. So that's been the biggest thing. And then another thing was when you're negotiating with them, a lot of people, I feel like, judging by what the listing agent said, don't want to buy a house when it has a solar panel loan, especially like in my case, it was over 50,000. So we were able to get them to pay, I think it was 10,000 off of that solar panel loan, to entice my buyers to want that property more. So I think that's a negotiating tool that you can use to your advantage if you have buyers that are interested in a property that have a loan of that nature. Oh yeah.
Thanks. I have a listing with solar and we're on the flip side of that. So
Yeah, it's definitely, so when you're finding people that are interested and want to go and buy it, make sure if they're serious about it, that they make a move on assuming that loan ASAP, or else you'll run into problems at closing.
yeah, no, I know it takes forever and we've had trouble expressing that to both the seller and buyers definitely don't understand that either. So
Yeah,
you're
neither
100%
did
right
not.
on that.
But the listing agent, like I said, to be honest, when it first started, I thought he was exaggerating, but that's because he was a pain in the ass from the moment I talked to him. But I was like, oh, he's not exaggerating. Like, this really takes forever.
Yeah. The apps even say that it can take 30 days, but people
Yeah.
don't think so. So, all right, thank you.
And then the last thing, the paperwork, like they had to fill out basically a form to assume the loan. And I thought that on the paperwork, so did my buyers, and I think Lee did as well. It asked you how much of, or what that loan was going to be, the amount. And I thought it was going to be the amount of the solar panel loan, but it turns out it was the amount of their mortgage on that new house. So it's a little tricky when they fill out that paper to go. I think it's called like the solar assumption checklist. It's something of that nature, and it's very confusing.
Interesting.
Because remember, Lee, we thought it was going to be the solar panel loan amount, but it ended up being the mortgage amount.
Yeah, it is.
That is weird.
The specific checklist that the lender provided for that, it was very confusing the way it was worded, because it did make it sound like it was referring to the solar panel loan. So then we're looking for, what's the payoff on the solar panel loan, because Matt's sellers are providing a credit toward that. So we needed to know what the payoff was, and then what the payoff minus the contribution they were making would be. And then come to find out it had nothing to do with the solar panel loan at all. It was all about the mortgage loan. So it did get confusing there for a little bit.
Yeah, I think on ours, they ask for they want to see the whole contract and everything to do with the buying of the house too. So
Yeah, my buyers had to submit a lot of stuff to them.
yeah.
Fortunately for Matt, one of the buyers is actually in the mortgage industry himself. So this is not entirely new news to him. It's different because his buyers are moving from out of state, but the basics are similar.
Yeah, that was definitely a benefit for sure.
Yeah. Ben, did you have anything you wanted to add? I heard you throat clearing.
Oh, no, sorry. I thought I was still muted. My phone's blown up since like 8:45, so.
That's fine.
What did everyone learn from Juan?
Well, I didn't
learned
really
that-
realize there were renovation loans. I mean, I guess I've heard the term, but never heard anyone explain it. So that was good. And also how they kind of maneuver around the alimony and child support.
And I learned that I guess I thought that USDA loans were more prevalent, because the area just outside Orlando is kind of rural in a lot of cases. So I just assumed that it was a pretty common thing, but turns out it's apparently not so common.
No, but his map did look a little bit more limiting than I think it is, because like it had areas to the west closed off, and I know like Mineola you can get them, which is in between Claremont and I don't know. I did encourage anyone looking at it to put in specific addresses to check if it's eligible, because I think there's pockets throughout.
And does anyone else have deal specific questions, concerns, or comments?
Well, if anyone hasn't seen my message on Slack, if there's anyone available between 12 and like 6 p.m. today to go do a showing in Lake Nona, it would be highly appreciative. If not, totally fine. So much chatting.
Yeah, everyone's dead today, apparently.
Hey, Douglas, I can do that for you. I can reach out to you on Slack, if that works.
Thank you so much. Yeah. reach out there. Thanks.
Yeah, you're welcome.
Also, I want to remind everybody to do the follow-up bus tag for our client appreciation holiday party. Jen needs those by the end of this week for sure. Those invitations have been ordered, and we want to make sure she has enough addresses to send out on Monday.
You actually bring up a great point that I want to hype on even more. Guys, so the holiday party that's coming up is going to be pretty great in the sense that it is at an art gallery. It's an easy way to super touch your sphere of influence in your audiences. So the question is, who are you inviting to that? Well, anyone in your sphere that is potentially buying a house, any prospect, any current client, any past client. It is a client appreciation event. And this is an opportunity that we're making super, super easy for you, where all you have to provide is names, addresses, and emails. And our team, your amazing support team, is going to print out all those invitations, stuff them in an envelope, hand address those envelopes, and mail them out to any of your invitees. There's going to be entertainment. There's going to be drinks. There's going to be appetizers. It's December 11th through 5 p.m. through 8 p.m. So it's going to be a great way to show off how amazing you are and that you're part of a great real estate team. And it's a great, easy touch point. Each one of you are able to invite 50 people. Please give us 50 names. Do I expect all 50 to show up? No, but that's why people love to get invited to parties even if they can't attend, which is why it's a great touch point for you to reach out to people, right? We're making this super easy. It's going to be a blast. I really want everyone to be there. And I want everyone to take advantage of using this method to market to your sphere, love on your sphere, and also bring them to the event. Does anyone have any questions about how that's going to be handled? All right. Well, that's wrapped up.
Not quite yet. I have just a couple of things I wanted to throw out there as well. First, if any of you have just a second to jump on Facebook and leave positive glowing reviews for Chic Event Furniture. They were the ones who donated the furniture to our Pride event this past weekend. And so super gracious, and the furniture was pretty kick-ass as well. So if you have a second to jump on Facebook and leave them a review, that would be amazing. Same with EON. If you can find them on Facebook and leave them a great review, that would be fantastic. I will provide the links to the Facebook sites in Slack and or email them to you, just so it's easy to find. But that would be the very least we could do, because they were so gracious in donating those items to us to allow us to use them. I think that that would be a really nice gesture from us. So thank you for that. The other thing, on Thursday from 11 to noon, there is a webinar that's being hosted regarding the MLS Touch app. So the MLS Touch app replaced the previous MLS app that we had available to us that a lot of us found was not terribly user-friendly, myself included. And so they've replaced it with the MLS Touch app. And the really cool thing about that is that it is brandable and also shareable with your actual customers. The cool thing for you is that those of you who have been on Joel's calls in the past, he's mentioned having a backstage pass to the MLS. This really does allow for that. And it will allow your customers to actually identify homes that are absolutely, I'm interested, or this is a maybe, or no thanks, I don't like this. You can see what they're choosing from your side, and they actually have access to the listings on the MLS themselves through their side. So Ben and I are going to consider how we can use team branding, because the MLS Touch app, of course, is assigned to each of you individually. But for now, I would encourage you to attend that just so that you know how to use it, how to get it out to your customers so that they can use it. And then, yeah, I think that that would be a really valuable tool for you. So that's tomorrow from 11 to noon. And I sent the calendar invite with the registration link included. So check your calendar for that.